Chapter 5. National Income Accounting. Measuring the economy. Measurement of aggregate economic activity helps answer such questions as how much output is being produced, what is it being used for, how much income is being generated, and what is happening to the prices and wages. So we go to the first part, measures of output. National income accounting is the measurement of aggregate economic activity, particularly in national income and its components. We go back to the GDP, or gross domestic product, which is the total market value of final output produced within a nation's borders in a given time period. And each good and service produced and bought to a market has a price which serves as a measure of value for calculating the output. So here we have a table on the measure of output. So last year's output we have, in physical terms, 2 billion oranges, 2 million bicycles, and 700 rock concerts. So what does that mean? We don't know. We gotta put it into monetary prices. So 2 billion oranges at 20 cents each. That's 400 million oranges. 2 million bicycles at $50 each. That is $100 million. And 700 rock concerts at $1 million each. That's $700 million. So total, we have $1,200 million. It is impossible to add up all output when output is counted in physical terms. And you gotta convert it to monetary terms. Accordingly, total output is measured in monetary terms, which each good or service valued at its market price. So, in this year's output, we have 3 billion oranges, 4 million bicycles, and 600 rock concerts. Again, it's in physical terms, it can't be measured. It's gotta be in monetary. So now we go to GDP versus GNP. GDP is gross domestic product, GNP is gross national product. And that is simply the output produced by a nation's factors of production, no matter where it takes place. So if the nation is involved, it could be in-state, out-country, whatever, it counts. GDP is geographically focused, including only output produced within the nation's borders, regardless of whose factors are used. So now we go to GDP per capita. The gross domestic product per capita is you take the total GDP divided by the population, which is the average GDP. GDP per capita is commonly used as a measurement of a country's standard of living. Measures of per capita GDP tell us nothing about how GDP is actually distributed or used. It's just a measurement, rough measurement. So now we go into measurement problems. Methods of calculating GDP entail measurement problems and accounting for all economic activity. We have non-market activities, which are goods and services produced that are not sold in a market. They're bartered. And we have unreported income, where market activities not reported to the tax or census authorities, such as waiting tables, cash under the table, and likewise. So now we go to value added. The production of most goods and services involves a series of stages. And to accurately measure GDP, we must distinguish between intermediate goods and final goods. Intermediate goods are goods or services purchased for use as an input in the production of the final good or service. So they're kind of halfway there. They're not all the way there. They're in the process of becoming. And then value added is the increase in the market value of a product that takes place at each stage of the production process. Interesting, huh? So, value added in various stages of production. We have a table. So, step 1, a farmer grows wheat and sells it to the miller. So it starts out at 12 and it goes to 12. The miller converts that wheat to flour and he sells it to the baker. So that's 28 cents, value added is 16 cents. The baker bakes bagels and sells it to the bagel store. That's 60 cents value added. That's 60 cents and the value added is 32 cents. And the bagel store sells the bagel to the consumer at 15 cents value added. So the total is $1.75, with the value added being 75 cents. Now, the wheat is an intermediate good, the flour is an intermediate good, the bagel is a finished good, I'm guessing, and then the bagel to the consumer. Interestingly, the biggest value added is the baker baking the bagel and selling it to the bagel store. which I would imagine would be a large-scale production. So it has the economies of scale on its side, leading to the biggest value increase. Okay, we go back to calculating gross domestic product. There are two ways to do that. Compute the final output in one of two ways. Count only market transaction entailing final sales and sum over all, or count only the value added at each stage of production and sum over all. So you can count the market transaction, final sales, sum over all, or the value added and sum over all. Now we go into real versus nominal GDP. Nominal GDP is the value of final output produced in a given period measured in the prices of that period, being current prices. The real GDP is the value of final output produced in a given period adjusting for changing prices such as inflation or deflation. Now we go into computing real GDP. Inflation is an increase in the average level of prices for goods and services. Inflation tends to obscure actual declines in real output. And then we have a base year, which is the year used for comparative analysis, the basis for indexing price changes. In computing real GDP, the general formula is real GDP in a year T equals nominal GDP in year T divided by the price index. Now remember what nominal GDP is? Nominal GDP is the value of final output produced in a given time period measured in the prices of that period. The price index represents a price level change as an index with a base of 100. Price index is 100 plus the percent change divided by 100. So now we go into computing real GDP. We have nominal GDP in the billions. Change in the nominal GDP from 2005 to 2006, you add $789. Change in the price level between 2005 and 2006 is 3.3%. So real GDP in 2005 dollars is $12,456, but in 2006 it's $12,882. Now you take the 13,245, divide that by the 3.3% over 100, and you get a positive 366 change in real GDP. Changes in GDP nominal versus real. Increases in nominal GDP reflect higher prices as well as more output. Increases in real GDP reflect more output only. So nominal brings another factor, which are prices. GDP is only output. It doesn't factor in prices. So nominal is a little bit more complex and a little bit more true and telling. Now we go into net domestic product. We won't be able to produce as much output next year unless we replace factors of production we used this year. Depreciation comes into play. The consumption of capital in the production process, the wearing out of plants and equipment. So basically you have a factory, you gotta upkeep that factory to produce, 90% or whatever. And if you don't do it, it'll start to decrease in efficiency, resulting in less output. So now we go into net domestic product. NDP. GDP less depreciation. So NDP, net domestic product, equals GDP minus depreciation. The amount of output we could consume without reducing our stock of capital. Investment. Expenditures on production of new plant, equipment, structures, which are capital, in a given time period, plus changes in business inventories. So investments would be buying new copiers, or upgraded copiers, or hiring new employees, or making new rooms for more product, for more output. So now we go into the distinction between GDP and NDP is mirrored in the difference between gross investment and net investment. Gross investment is the total investment expenditure in a given time period, and net investment is gross less depreciation. It's basically gross worth and net worth, Net worth is really what matters. So the stock of capital is the total collection of plants and equipment will not grow unless gross investment exceeds depreciation. So if you want to grow, you gotta have a positive net worth. Pretty self-explanatory. Now we go into the uses of output. The major uses of total output conform to the four sets of market participants. We have households, business firms, government, and international participants. Households are in consumption. Business firms are in investments. Government is government spending, which is a mix of the two, I'm sure. And then we have international participants, which are net exports. So households, consumption. Consumption. What is consumption? Consumption is goods and services used by households. The goods and services used by households are called consumption goods, which include all household purchases made in product markets. The consumer spend claims over 2/3 of the annual output in the United States. So they're both laborers, working, and then they are consumers. Such as food, utilities, spending money, vehicles, such and such. Those are consumption goods. Now we go into investment. Investment goods are the plant, machinery, and equipment that we produce, such as cars, and businesses, output, and bagels and stuff. And then this also includes a net inventory change in new residential construction, which are homes. Investment spending claims about 1/6 of our annual output. So we got consumer goods at 2/3, investment spending 1/6, and now we move into government spending. Government spending are resources purchased by the public sector, the government, and are unavailable for consumption or investment purposes. Government spending on goods and services claims about 1/5 of our annual output. That is 20%. This does not include income transfers. So this is, I guess, paving the roads, and paying the police officers, paying teachers, keeping libraries open, parks open. That is government spending. And now we go into the fourth one, which are net exports. Net exports are the value of exports minus the value of imports. So you have exports, goods and services sold to international buyers, and then imports, goods and services purchased from international buyers, or sources, for that matter. So an example, we are importing oil, and we are exporting cars, or food. So now we go into gross domestic product components. The value of GDP can be computed by adding up these expenditures. GDP equals C plus I plus G, parentheses, open parentheses, X minus M, close parentheses. So what does that mean? GDP is the consumption of expenditure plus the investment expenditure plus the government expenditure, and then in the parentheses you have the exports and the imports, which will be either a plus or a minus number, hopefully a plus, and then you add all that up and you get your gross domestic product, which is the total output of a geographical area in a fixed time period. So now we go into measures of income. Instead of looking at who's buying the output, the demand side, we can look at who's being paid to produce, or the supply side. The total value of market incomes must equal the total value of final output, or GDP. So output equals income. So here we have a graph, the value of output. We've got consumer spending, investment spending, government spending, and net exports, that is the product market. And that is linked to the factor market, which is the value of income. We have wages, rent, interest, and profits, and they should equal each other. Now we go into the equivalence of expenditure and income in billions of dollars. So we have our expenditure side and our income side. They should equal the same. We've got C, consumer goods and services at 10 grand. I, investment in plant, equipment, and machinery and inventory, which is in investments. We've got about 2 grand. We've got G, which is government goods and services at 2.8. We've got X, which are exports, which is at 1.8, and then we've got M, which are imports, which is at 2.5. So total GDP, total value of output, is $14,265. Now we go on to the other side of the coin, the factor market, which is income. So we've got wages and salaries, corporate profits, property, proprietor's income, rents, interest, taxes on outputs. Now that interest, rents, actually, we got wages and salaries, corporate profits, and proprietors' income. Proprietors being the business, so that's about 10, and that's even to C. Then we've got rent, interest, and taxes, depreciation, statistical discrepancy, blah blah blah. And that's basically the end of the game. You want it to be output equals income, and they should be equal. So we go into national income. By charting the flow of income, we see for whom the output is produced. And remember those three questions: for what it's produced, how it's produced, and for whom. Now we're charting this income, we see the for whom question answered. Depreciation charges reduce GDP to the level of net domestic product before any income is available to current factors of production. So depreciation is always a factor. NDP equals GDP minus depreciation. Net foreign factor income. Wages, interest, and profits paid to foreigners are not part of the U.S. income and need to be subtracted from the income flow. Incomes earned by United States citizens in other nations represent an inflow of income to United States households and are added. So you have a bunch of outsourcing going on. It's not added to the income. But if you have a lot of people working outside of the country for the country, they are added. Their income is added. So now we go into national income, or NI. National income is the total income earned by current factors of production. National income equals NDP plus the net factor of income. We go into personal income, or PI. Income, which is income received by households before payment of personal taxes. PI equals NI minus indirect business taxes minus corporate profits. Interest and miscellaneous payments, social security taxes, addition of transfer payments, and capital income. Now we go to indirect business taxes. When goods are sold in the marketplace, their purchase price is typically encumbered with some sort of sales tax. These taxes on production and imports do not represent payments to factors of production. Corporate profits. Corporate taxes are retained earnings. Represent part of corporate profits not received by households, so they're subtracted from the national income. And all corporate profits are subtracted, then that part of profits paid to households is later added back in and under capital income. A little confusing. So basically, money is moving around. Now we go to payroll taxes and transfers. Social security taxes are also subtracted. Workers never see this income because it's withheld by employers and sent directly to the U.S. Treasury. Income in the form of transfer payments is added. And this brings us to capital income. People also receive interest payments and dividend checks. These forms of capital income provide another source of personal income. Like, say you have a high yield savings bank, you get, a few dollars a year because you use that. Now we go into disposable income, or DI. This is after-tax income of households, personal income less personal taxes. This is basically the money you're walking away with when you cash your check. So the formula is DI equals personal income minus personal taxes. Disposable income, saving. That part of disposable income is not spent on current consumption. Disposable income less consumption. All disposable income is either consumed by buying groceries, goods, rent, stuff like that, or saved and put to better use. So here we're on a chart of the flow of income in 2008. We've got GDP, which is $14 billion, less depreciation, which is 1.832. We have we have a net domestic product, or NDP, of 12,000. We have the addition and subtraction of net foreign factor income and statistical discrepancy. So our national income is 12 billion. Now you take away business taxes, you take away profits, you take away interest and miscellaneous payments, you take away Social Security, and then you have these transfer payments, and then capital income, which is brought back, and then your personal income is 12 billion. You take away taxes, and then you're left with your disposable income of 10. So you start out with a GDP of 14, and then you get it taken away down to 10. So now we go into the flow of income. The dollar value of output will always equal the dollar value of income. So output equals income, back to the slide before. Total income, or GDP, ends up being distributed in a number of ways. Three ways, actually. We've got to households in the form of disposable income, DI. We've got to businesses in the form of returned earnings and depreciation allowances, and to government in the form of taxes. So income and expenditure. The flow of income that starts with GDP ultimately returns to the market in the form of new consumption, C, investments, I, and government purchases, G. So now we have a circular flow of spending and income. We've got a chart here of the market GDP, and that goes to businesses, which is depreciated, and you have the NBP, and then that goes to net foreign factor of income, and the factor market, which is NI, national income, and then you have really complex, which goes down to the household. We have really complex going into international business taxes, Social Security, corporate taxes, and then you get interest back and transfer payments back, and then you pay taxes on it, and then that goes to the households. The household is divided into savings to the left, or it goes into consumption, which drives the GDP. And that is the complex chapter of Chapter 5 in National Income Accounting. Next up is Chapter 6. Bye-bye.